Welcome back to the deep dive. Today, we are cutting through the confusion on a topic that can feel just impenetrable. We're talking about navigating debt when it becomes totally overwhelming. We're doing a deep dive into what is probably the most misunderstood financial reset button out there: bankruptcy. Think of this as your essential guide. We want to clarify what filing for bankruptcy actually does, and maybe more importantly, what it absolutely doesn't do. Our mission today is pretty simple. We are diving into the two most common types, that's Chapter 7 and Chapter 13, to really spell out what debts can be wiped clean, what can't, and the serious long-term consequences you have to know about.
And it's so important to set the stage right away. Bankruptcy is, it's a very serious legal tool. It's governed by federal law, and it's designed to give people a genuine financial fresh start. This happens in one of two ways, either through liquidation of assets, which is Chapter 7, or through a structured repayment plan, which is Chapter 13.
Yeah.
The whole point, really, for anyone filing is the debt discharge. That's the key term. Once a debt is discharged, that's it. The creditor is legally permanently barred from coming after you for that money.
They can't seize anything.
Nothing. They can't seize collateral. They can't call you, nothing. But the system is. It's complex. Most consumer debt, credit cards, medical bills, that could be discharged.
Yeah.
But the law has this list, 19 categories of debts that are almost always non-dischargeable.
And some of those are surprising, right? Like certain taxes or debts from willful and malicious injury.
Exactly.
Okay, so let's unpack that. You have these two main roads to go down. Chapter 7, which is liquidation, and Chapter 13, the repayment plan. Let's start with Chapter 7. This is the one people think of as the fastest path. A clean slate in just a few months.
Usually, yes. About 4 months after filing, typically.
But there's a big hurdle right at the start. It's called the means test.
That's the gatekeeper. It's a two-step mathematical check, basically. The court looks at your average income for the last 6 months.
Okay.
And they compare it to the median income for a household your size in your state. If you're below that median, you qualify. Simple as that.
And if you're above it?
If you're above it, you go to step 2. The court calculates your disposable income. They take your income and subtract allowed expenses, things like your mortgage, car payments, basic living costs.
And if there's too much left over?
Exactly. If that final number suggests you could afford to pay back some of your debt, then you won't qualify for Chapter 7. Chapter 13 becomes your only real option.
And that's because of the liquidation piece, right? That's the part that's so tough in Chapter 7. A trustee comes in and sells your stuff.
That's right. They take control of your non-exempt assets and sell them to pay your creditors.
So what's non-exempt? What are we talking about here? What do you actually lose?
And that's where the real pain comes in. You get to keep what are called exempt assets: your clothes, tools you need for work, your pension, Social Security, and a certain amount of equity in your house and your main car.
But the non-exempt stuff is what's sold.
Yes. A second car, a boat, an RV, investment accounts, valuable collections, any real estate that's not your primary home. The trustee's job is to get as much money as possible for the people you owe.
That distinction, losing a second car but maybe keeping your main one, that's huge for someone trying to rebuild. So, okay, let's look at the alternative. Chapter 13, reorganization.
Chapter 13 is a totally different approach. Instead of selling your assets, you commit to a court-approved repayment plan. It lasts either 3 or 5 years.
Depending on your income.
Depending on your income, right?
Yeah.
And the huge benefit here is you get to keep all your assets, even the ones that would have been sold in a Chapter 7. You make one monthly payment to the trustee, and they pay your creditors. At the end of the plan, the rest of the qualified debt is discharged.
So why would someone who could pass the means test for a Chapter 7, why would they choose the longer path of Chapter 13?
That's a great question. It gets right to the strategy. You might do it if you have valuable non-exempt assets you just can't lose. Family business, maybe. Or a house with a lot of equity, more than the exemption allows.
Or if you're behind on your mortgage.
Exactly. Chapter 13 is perfect for that. It can stop a foreclosure. It gives you time within the plan to catch up on those missed mortgage or car payments without losing the asset.
So it's a tool for people caught in that horrible middle ground.
But financial advice, really. We saw that example in the source material. Someone with $500,000 in debt, a $4,000 mortgage, but only $2,000 a month in income? The math just doesn't work. For them, bankruptcy isn't a choice. It's the only way to stop the bleeding.
Okay, this is where our deep dive really gets critical. We mentioned those 19 categories of debt that bankruptcy just can't touch. You have to know what's going to stick with you no matter what.
Absolutely. The universal exclusions are, they're non-negotiable. First and foremost, family support, alimony, child support, never dischargeable. Not in Chapter 7, not in Chapter 13.
That makes sense.
Similarly, any debts for death or personal injury that you caused while driving intoxicated, that's off the table, period.
And what about that willful and malicious injury one? That sounds like it's there to protect victims.
It is, precisely. The law draws a line between an accident negligence and something you did on purpose. Willful and malicious means it was deliberate and without just cause. Think of debts from an assault or from fraud.
Really high bar.
A very high bar. And there's a fascinating difference here between the chapters. In Chapter 7, if you maliciously injure a person or their property, that debt is not dischargeable.
Okay.
But in Chapter 13, a debt from damaging property might be dischargeable, but the debt for injuring a person is still not. The law prioritizes protecting people over property in that case.
That's a really interesting distinction. So are there any other little traps specifically for Chapter 7 filers?
Yes, a couple. If you file Chapter 7, you'll still owe any condo or co-op fees that come due after you file. Those are ongoing obligations. And of course, any debts you forgot to list or listed incorrectly on your paperwork, those won't be discharged either.
But you can usually keep your house or your car as long as you're current on the loan.
You can, but you have to reaffirm the loan.
Which means?
It means you sign a new agreement with the lender saying you'll keep paying and you'll remain personally liable for that debt even after the bankruptcy. It's a risk because that debt is not discharged, but it's how you keep the collateral.
Okay, let's pivot. Let's talk about the two big ones that cause the most anxiety for people: income tax debt and student loans.
Tax debt is incredibly complex. People assume you can't discharge any taxes, but that's not quite true. Tax debts which are secured by your property are almost impossible to get rid of.
But unpaid income taxes?
Certain unpaid income taxes can be discharged, but they have to meet a very strict set of rules, all based on timing.
Timing? What kind of timing?
There are three main tests. First, the tax debt had to be due at least 3 years before you file. Second, you had to have actually filed the tax return at least 2 years before. And third, the IRS can't have assessed the tax within 240 days of your filing.
So if it's recent tax debt or you never filed?
Forget it. It's not dischargeable. That's why fighting it out in bankruptcy court is so difficult.
Which brings up a better strategy, maybe: negotiating with the IRS before you even think about bankruptcy.
Almost always a better first step. The IRS has formal programs. There's something called an offer in compromise, where they'll accept less than what you owe if you can prove you can't pay the full amount.
Because they'd rather get something than nothing.
Exactly. Or there's an installment agreement, which is just a long-term payment plan. It lets you get right with the IRS without that huge bankruptcy stamp on your credit report.
Okay. Now for student loans. For decades, everyone just knew you can't get rid of student loans in bankruptcy.
And for decades, they're pretty much right. It was nearly impossible. You had to file a whole separate lawsuit within your bankruptcy. It's called an adversary proceeding.
A lawsuit against the lender.
Yes. And in that lawsuit, you had to prove undue hardship. It was this incredibly high legal standard. Most courts use something called the Brunner test, which basically meant you had to prove you couldn't maintain a minimal standard of living and that things were unlikely to ever get better for you.
That sounds expensive and almost designed to fail.
It was. It cost thousands in legal fees, and courts almost never granted it.
But the sources say something big changed recently. This is a critical update.
It's a game changer. In November 2022, the Department of Justice issued new guidance that standardized the whole process. It streamlines what you have to prove, it creates a standard form, it makes it much less difficult and costly just to make the request.
So streamlined is one thing, but does that mean it's now easy? Is the floodgate open for discharging student loans?
That's the key question. No, it's not easy. The burden of proving undue hardship is still there. But the new guidance makes the process more uniform and accessible. It lowers the barrier to entry. It's a real step toward fairness, but you still have to show a genuine, long-term inability to pay.
All right. We've laid out the options, the rules, the exceptions. Now we have to talk about the true cost. If you hit that reset button, what follows you? What are the real consequences?
They're severe.
Yeah.
And you have to weigh them very, very carefully. First, your credit. A Chapter 13 stays on your credit report for 7 years. A Chapter 7 for 10 years.
10 years.
10 years. Your credit score will plummet, often by hundreds of points, right away.
And that affects everything.
Everything. Getting a mortgage, a car loan, even a basic credit card becomes either impossible or incredibly expensive because of the high interest rates. It can even affect your insurance rates or your ability to rent an apartment.
And we have to say it again. In Chapter 7, you lose property. That second car, that investment account, it's gone. For good.
Beyond the financial loss, there's a psychological toll. There's a real social stigma that can come with having to publicly acknowledge that things have gone wrong.
Which is why it's so important to look at alternatives first, like
Yeah.
just talking to your creditors.
Absolutely. Creditors are rational. They know that if you file for bankruptcy, they might only get pennies on the dollar. They're often willing to negotiate, lower an interest rate, forgive part of the debt, because getting some money is better than getting almost nothing.
And how does something like debt settlement compare?
Debt settlement is where a company negotiates on your behalf to pay a lump sum that's less than you owe. It can be faster than a Chapter 13, but
Right.
it comes with hefty fees, and it doesn't always work. Creditors don't have to agree. Bankruptcy is more damaging to your credit, for sure, but it's much more definitive. It can wipe the slate clean.
So if you do decide to file, there's a path to recovery. What's step one?
Step one is mandatory, actually. You have to get credit counseling from an approved agency before you can even file, and then you have to take a financial education course after.
And then just watch your credit report like a hawk.
You have to. Make sure every single discharged debt is reported correctly. That 10-year mark for Chapter 7 is a long time, and you don't want errors making it even worse.
And what's the best tool for actually rebuilding?
The secured credit card? No question. You give the bank a cash deposit, say $500, and that becomes your credit limit. The bank has no risk.
Because they have your money.
Exactly. You use that card for small things, pay it off in full every single month, on time, without fail. That slowly, gradually proves you can be trusted with credit again. It's the first step back.
So to wrap up our deep dive, you've got Chapter 7, the quick liquidation for those with the fewest resources, which involves losing assets. Or you have Chapter 13, the slower path to keep your assets, but it requires a 3 to 5 year repayment plan.
And no matter which path, you have to be ready for the credit impact. You have to get professional advice because the rules, especially on what you can keep, change from state to state. The damage is serious, but it's not permanent. You can rebuild.
And we want to leave you with one final thought, something people rarely consider about this choice. We've talked about the damage to your credit, which is tracked by private companies, but remember this. A bankruptcy filing is a public record. It's filed in federal court. That means anyone, a future employer, a landlord, even a nosy neighbor, can request a copy and see your entire financial situation laid bare. Your debts, your assets, everything. It's a public statement. And that, too, needs to be part of the calculation.